What's going on? Alex here, and I came across a tax question that I thought was especially pertinent given what's going on in the stock market here on Reddit, and I wanted to read it to you guys, and hopefully in answering this question, it helps you navigate some of the interesting times that we're currently experiencing. So let's take a look at the question, and it comes from ME_PhD. And this person asks, I have a regular W-2 salary job earning X number of dollars per year. I also bought some stocks a few weeks ago and lost $20,000. Sorry to hear that. Should I sell my stocks for loss and rebuy immediately? Would I be able to deduct $20,000 from my 2020 income? Would it be as if I earned X minus $20,000 for the year? So, very interesting question. And in this case, it's important to consider what actually transpired, right? If you step back and take a look at the transactions, you held stock, then you sold it, then you want to purchase it right back. So essentially, nothing really changed. You had the security before, you sold it for a little bit, and then you bought it right back, which means that the series of transactions there can be looked at as a wash, meaning that nothing really transpired. So with that said, the clever people in Congress, nobody ever gives them any credit, but they do deserve some credit. They saw this coming from miles away. And they knew that taxpayers were going to try to do exactly this, meaning that a security drops in value, you sell it to realize the loss from a tax perspective, or that's your intent anyway, and then you intend to then purchase that security right back. That's why you would be subject to the wash sale rules. They saw this coming from miles away. Now, what are the wash sale rules? So basically what they stipulate is that if you purchase a security that you sell, if you make the purchase within 30 days prior to the sale or 30 days after the sale, it's both, then that sale will likely be a wash sale in that you will not be able to deduct the $20,000 loss. And actually, you will not be able to deduct any loss, because what happens is that loss that you would have deducted, that let's say 20,000, gets added to your basis until you finally dispose of the stock in a non-wash sale transaction down the road, and there's rules that go along with that. But the point is, it takes the breath out of being able to take these losses immediately, and certainly you won't be able to offset the $20,000 in, let's say, wage income with those losses. So the question then becomes, can you somehow navigate through these wash sale rules to enjoy some sort of tax benefit? And that all comes down to an important definition. And that comes from Code Section 1091 right here. And what we're looking at is loss from wash sales of stocks or securities. And there's a lot of words here, but the key term that you need to take into account is substantially identical stock or securities. All right. And what that means is that the tax code is structured in a way where they don't want you to sell a particular security, then buy back a substantially identical stock or security and take losses based on the sale that you did in the first place. And the question then becomes, what is substantially identical in terms of stocks or securities? So if you have the stock of one corporation and you sell it, you buy stock of a different corporation, that may not be viewed as being substantially identical, and you can basically take the loss on one sale and then make the purchase, and there's no negative tax implications, and that you will be able to deduct some of the capital losses. There are rules pertaining to that, but that's going to allow you to possibly get around the wash sale rules. Similarly, if you have, let's say, a technology security that you have, and you sell that and you purchase an ETF which tracks the technology industry, that also may allow you to avoid getting stuck with these wash sale rules and be able to actually use the loss from the sale. Now, the first consideration is whether it's substantially identical stock or security. So if you can get past that, in that the stock that you purchased is not substantially identical in terms of what you sold, then the challenge becomes, how do you take the loss? So if you sold for $20,000 loss and you've repurchased a security that's not substantially identical, then you would be able to deduct up to $3,000 at the federal level, up to $3,000 against ordinary income. So if you have, let's say, $100,000 in wages and you sold for the $20,000, you're going to only get in this year, assuming you have no other capital gains, up to $3,000 deduction against your ordinary income. So your salaries and wages, you can only reduce them by up to $3,000 of the losses that you sustained. The rest of those capital losses are going to be used to offset capital gains if you have them in 2020, or if you don't, they'll be carried forward indefinitely until you use them all up. So it's called the capital loss carryover or capital loss carry forward. So the first question is whether you're purchasing either within 30 days before or 30 days after the sale, works both ways, substantially identical stock or securities right here. That's where we see that. And if that is the case, then you have to deal with the wash sale rules, meaning that loss that you would have had, that $20,000 loss, is now added to the basis of the new stock that you purchased, so that there's no immediate loss at all that comes from that. You'll get a benefit when you finally sell the stock in a taxable transaction and so forth down the line. Now, if you do purchase within the 30 days before, 30 days after the sale, non-substantially identical stock or securities, then you may be able to recognize the loss, but you're limited to how much you can deduct against ordinary income in a particular year, and that limit is $3,000 for federal income tax purposes. So either way, I'm sorry to tell you that depending on the specific securities you had, sometimes if you hold certain investments, there might be different rules applicable, but in the vast majority of cases, you will not be able to take the $20,000 deduction in 2020. You can forget about all that. But if you reinvest in a non-substantially identical stock or security, then at least you'll be able to enjoy some of the capital losses there, up to $3,000, and then any other capital gains that you generate either in tax year 2020 or later tax years, you can use the rest of that $17,000 to offset those. So there is more of a tax benefit there if you avoid the wash sale rules and you avoid purchasing before or after the sale substantially identical stock or securities. So hopefully, ME_PhD, this was helpful, and good luck in navigating taxes and the stock market, and thanks for watching.